Welcome to the Deep Dive, the Talk Tickers edition, where we surgically dissect quarterly reports and earnings calls to give you the strategic roadmap for complex companies.
And today we are diving deep into Zymeworks, ticker ZYME.
Right, following their Q3 2025 results that dropped on November 6th.
And that timing, it was everything. For Zymeworks, this quarter was the absolute definition of a mixed print. The accounting figures told one story, but the looming clinical catalysts were telling a completely different one.
A much more dramatic one. We saw the market react in real time, didn't we? It was kind of a muted reaction at first, then a pretty big sell-off the next day.
Total whiplash. Because everyone was trying to figure out, how do you weigh a revenue shortfall against a huge milestone payment, all while knowing the company's biggest data of the year could drop any second.
Exactly. So our mission today is to filter out that short-term financial noise, the gap accounting stuff, and really focus on the clinical value drivers. We're tracking Zymeworks' big strategic shift here.
Yeah, moving from that classic, cash-burning biotech
to this new hybrid model they're calling the royalty plus pipeline story.
So let's just lay out that mixed print right away. On the bottom line, it was actually a solid beat. Zymeworks reported a net loss of negative 26 cents per share.
And that was better than expected, right?
Much better. The street was looking for a loss closer to negative 33 cents. So it's a 7-cent beat, which suggests they're keeping a good handle on costs.
Okay, so that sounds like a clear win, but the confusion, like you said, was all about the top line. What did the revenue actually look like?
The revenue was the disappointment. Total revenue came in at $27.6 million.
Which, on its own, is a huge year-over-year increase.
A massive 72.5% jump, which, you should celebrate. But the problem was the street had their expectations set higher, somewhere around 30 million.
So they missed by about 2.4 million, and that's where the nerves started to kick in.
Yeah, because you have to look inside that 27.6 million number.
Right. Where did it come from?
It was overwhelmingly milestone heavy. The lion's share, a full 25 million of it, came from just one event.
The J&J payment.
The J&J payment, a development milestone because their partnered asset, pasritamig, entered phase 3. That's a one-time check.
Not recurring. So what was the recurring part?
That's the key. The recurring royalties from Zanidatamab, which is marketed as Ziihera, that was only about $1 million.
So the royalty side of the royalty plus pipeline story is still very, very early.
Extremely early. And the market saw that. The stock closed down 8% the day after earnings, trading at $16.46. It was like investors just threw out the J&J check and said, okay, the real business here isn't big enough yet. We're waiting for the clinical data.
Which is the perfect summary. So let's dig into those deeper financials and see how management is actually managing this transition.
Right, because this whole strategy hinges on capital discipline.
Okay, so despite that revenue miss, the cost control story seems to hold up. The net loss got better, right? Down to 19.6 million from almost 30 million a year ago.
It did. But even with that big $25 million check, the net margin is still, deep in the red, around minus 71%. They're still burning cash, just a bit slower.
And how are they managing that burn? What about R&D spending?
They're being very strategic there. R&D spend was kept pretty much flat year over year at 35.6 million. And management was really clear about this on the call. They're shifting capital away from some of the, let's say, peripheral research and focusing all that firepower on their core high-conviction ADC programs.
ZW191 and ZW251.
Exactly. But, for a biotech, flat R&D can be a bit of a double-edged sword. It shows discipline, but some might say you're not innovating fast enough.
It's a fair point, but they frame it as spending smarter, not just spending less. And that discipline is what's propping up the balance sheet. They ended the quarter with $299.4 million in cash.
And that's before the J&J money actually hit the bank account, right? Correct. That 25 million milestone was earned in Q3, but wasn't expected to be received until Q4. So you're really looking at a cash position of almost $325 million.
Which gives them a ton of security. Management said their cash runway now extends well into the second half of 2027.
And for anyone who doesn't follow biotech, a 2-year runway is basically a lifetime. It gives them incredible leverage.
And lets them do some interesting things with capital, like the share buybacks. That's pretty unusual for a company at this stage.
It's fascinating. They spent $22.7 million buying back their own stock at an average price of $15.80. They're using cash from partners like J&J to reward shareholders.
It's like they're testing their own discipline. recycle partner cash instead of just dumping it all back into the R&D furnace.
And they signaled something even bigger. They basically said future milestone payments won't just fund their internal drugs. They're actively thinking about using that cash to go out and buy external royalty assets.
Creating a flywheel.
Exactly, a self-sustaining funding loop. Partnership success funds internal R&D and external revenue streams, which then fuels more growth without having to go back to the market for more money. It's a huge pivot.
Okay, so that makes the whole strategy sound much more robust.
Mm-hmm.
But let's get to the real engine of value here, the pipeline. This is what actually moves the stock.
Absolutely. And this is where management was, as you said, constructively bullish. The star of the show was the early phase 1 data for ZW191.
Their folate receptor alpha-targeted ADC. What were the headline numbers that got everyone so excited?
The objective response rate, or ORR, was 53% overall. And you have to remember, these are heavily, heavily pretreated patients.
Wow, okay. That's a strong number on its own.
But it gets even sharper. When you zoom in on gynecological cancers, the ORR jumped to 64% at the higher doses. You have to compare that to the competitors. It suggests this could be a best-in-class drug.
Of course, with ADCs, the big question is always toxicity. You can have great efficacy, but if the side effects are too harsh,
it kills the drug. But the safety profile here looked highly favorable. It was all the manageable stuff you'd expect. Nausea, fatigue. Critically, there were no serious treatment-related adverse events that made patients drop out.
And a clean safety profile is everything for combinations down the road.
It's the whole ball game.
So what's the next step for ZW191? Where do they go from here?
They're moving fast. Dose optimization is set to start this quarter, Q4. They've picked 2 doses to study specifically in ovarian cancer to find that perfect balance of efficacy and safety before they go for approval.
And they're also expanding the pipeline with ZW251. This one's going into a really tough area.
It is. They just dosed the first patient. It's an ADC targeting GPC3 for hepatocellular carcinoma, or HCC, liver cancer.
A notoriously fragile patient population.
Exactly. And the design of the drug reflects that. They deliberately chose a lower drug-to-antibody ratio, or DR, of 4.
Can you just quickly define GR for us?
Sure. DR is just the average number of chemomolecules attached to each antibody. Higher DR, more killing power, but usually a lot more toxicity. By going with a DR of 4, they're prioritizing tolerability for these HCC patients.
It shows they're thinking about the real-world patient, not just the data sheet.
Right. And speaking of discipline, they also cut a program, the ZW171 T-cell engager. They basically said it wasn't going to meet their high standards, so instead of wasting money, they're reallocating it to the ADCs.
Smart triage. And they gave us a little peek at what's next, right? This ZW209 program.
Yeah, this is where the platform tech gets really exciting. It's a tri-specific T-cell engager, but the key innovation is that it uses CD28 co-stimulation.
Okay, so most T-cell engagers are a single signal. They just connect the T-cell to the tumor.
Right, they press the brake. But the T-cell gets tired out pretty quickly.
It's connected, but it runs out of gas.
Precisely. The CD28 co-stimulation is like stepping on the gas pedal at the same time. It's a second signal designed to prevent that T-cell exhaustion and hopefully lead to much more durable responses. It's high-risk, high-reward science.
And this all points back to that main strategy. A royalty platform plus a few wholly owned ADC blockbusters.
Yeah.
And the immediate test of that whole model was the biggest catalyst of all.
The Ziihera data. On the call, their partner Jazz confirmed they were including all 920 patients from the Horizon GA01 trial in the analysis.
This is for first-line gastroesophageal adenocarcinoma, and the endpoints were PFS and overall survival.
The gold standards in oncology, progression-free survival and overall survival. And management confirmed on the call that the top-line PFS data was still coming in Q4. This was the event that could de-risk the entire company, making the Q3 financials almost irrelevant.
And we all know what happened. Just a few days after this call, that data dropped, and the stock shot up over 29% in a single day.
It confirmed everything. The market is trading this company on clinical validation and the future value of that royalty stream, not on a $2 million gap revenue miss.
It's all about the science. Okay, let's switch gears and go to our final segment. This is a stock that's up nearly 75% in the last year, crushing the biotech index. It's defined by these huge, volatile data drops.
And that kind of setup demands a more sophisticated way to think about positioning.
Absolutely. And as always, we have to stress this is purely a thought exercise. This is not financial advice. This is an outrageous but plausible trade idea designed to leverage that new, validated conviction in the platform.
So my thesis is simple. Zymeworks' value is now totally disconnected from quarterly P&L. It is 100% anchored to Ziihera's success and proving out the internal ADC engine with ZW191. That 30% surge proved the market will pay up for clinical wins.
So you want to play for that sustained long-term value, but you have to protect against the volatility after such a big run-up. How do you structure the trade?
I'd pitch a synthetic, long position that's designed to short volatility while extending your time horizon. The play is to sell near-term, high-delta, out-of-the-money puts, maybe using the January 2026 expiration.
Okay, let's break that down. Why are you selling puts?
You're selling puts to collect that fear premium that existed right before the big data release. You get paid cash today. Out of the money means the strike price is below where the stock is trading now, and by selling them, you collect a premium, which effectively lowers your cost basis for the second part of the trade.
You're harvesting the short-term uncertainty. So what's the other side of the trade?
At the same time, you use that premium to help buy deep, long-dated calls, maybe out to Q3 2026. This is your bet that the royalty stream and the next clinical data points like ZW191's dose optimization will drive the stock way higher over the next 12 to 18 months.
That's an aggressive play. You're exposed if that next set of data disappoints. You're betting the premium you collected is enough to cushion a short-term drop.
That's the risk, absolutely. But the bet is that the combination of a validated Ziihera platform and a cash runway into 2027 makes the long-term story much more probable than a catastrophic failure. It's a bet on the platform over the P&L.
That is a powerful way to frame it. It forces you to look completely past the quarterly reports.
It does. And the critical takeaway for you, listener, is this. Zymeworks' earnings calls are going to sound very different going forward. They won't really be about JAP results anymore. They'll become these strategic capital allocation discussions.
Right.
And the main question will be, is management successfully funding their high-risk internal ADCs while also using that partner cash to buy lower-risk external royalty assets? That execution is what will define this company's value for the next 5 years.
An excellent thought to end on. The shift from a pure biotech burner to a strategic compounder is a tough one, but they've laid out a very clear map. Thank you for joining us. Remember, everything we discussed is for informational purposes only. Do your own research. We'll catch you on the next deep dive.